This video is going to discuss how to recognize dilution by looking at a chart on a penny stock. Dilution is when new shares get added to a company's outstanding shares. So say the outstanding share count is 100 million, only 100 million shares can trade on that stock at any time. Now, dilution is when, say, now 10 million more shares get added to the outstanding share count. So now it goes from 100 million to 110 million. Now, why is this important? Well, if you just think simple supply and demand, it's easier to rise on 100 million shares worth of supply than it is to rise on 110 million shares worth of supply, because now you need 10 million shares worth of demand to keep up with the dilution that's gone on. Now, being able to spot dilution is very important, and it's really quite simple and just involves a lot of common sense. We're going to use a couple examples. Dilution on stocks that go down, but also just because there's dilution going on doesn't mean a stock can't go up. First things first, we're going to cover how do you notice dilution. What you want to be doing is comparing volume to previous volume. So here we'll use the example with CCWF, Church and Crawford Incorporated. We're looking at a 50-day chart. As you can see down here, it really didn't trade that much volume the last 50 days. 677,000 shares on Thursday, December 8th was the most volume it had ever traded. Okay? So then you had another 500,000 share day and a couple more 500,000 share days. But overall, the thing to take away coming into today is that not that much volume had traded on CCWF. Now watch what happens when we look at what happened today. Look at that huge spike in volume. We're talking 5.2 million shares traded today. That's more than all of this previous volume combined. So where are those shares coming from? How is this? It just doesn't make any sense. It's a red flag. If it doesn't make sense to you, it's probably not going to make you money. If it doesn't make sense, it's not going to make you money. So it's no surprise, look what's happened. Once the stock started dropping, now there's just tons of dilution going on. Again, how do we know it's dilution? Because we're assuming it is based on the fact that before today, it hadn't traded more than 677,000 shares, and now all this volume, 5 million shares has traded. There hasn't even been 5 million shares traded in the last 50 days, so you can't even say that it's just the people who got in before today selling, because that wouldn't account for all the volume. The company or insiders or promoters, somebody is clearly diluting the stock. We'll look at another example. STKO, Stay Cool Incorporated. So if we focus on this section of the chart, you'll see okay, let's get this the right way. All right, we'll do it the hard way. Okay, look at STKO. We're looking at a 50-day chart of STKO up until December 12th. Okay? You can see once again, similar to CCWF, STKO had never traded more than 450,000 shares. It traded less than 400,000 on the 1st of December. So overall, the thing to take away is that there's not that much trading activity in STKO. Okay? But then look at what happens. Look at this huge spike on December 15th, 1.8 million shares. Again, way above average compared to the previous trading history. So, you know, once again, that's a red flag, and it's likely dilution. Because where is such a great amount of shares coming from when the stock has never even traded more than 500,000 shares in a day? Now, those are two examples of dilution on the downside and what it can do. But you can also see, if we look at something like AMWI, which had absolutely no trading history up until November 16th, when you look, look at this. Nothing at all. But then you go out and boom, on the 17th of November, 71 million shares trade. So that's definite dilution. But what's the major difference between AMWI and CCWF and STKO? Unlike CCWF and STKO, which had dilution and the shares were red, AMWI had dilution, but the shares were able to go green. It opened at 7 cents and closed at 17 cents. So it was up over 200% just about that day. So it doesn't have the same ramifications, because people, when they see dilution and they see that a stock is red, they say, oh, I'm not going to touch that. There's too much dilution. They're dumping. They're not letting it rise, you know, so on and so forth. But if they see dilution and the stock is able to go green, they say, okay, there's definitely dilution going on, but they're letting it rise. They're not just killing it. They're not dumping it completely like CCWF today, for instance. On AMWI, there's a lot of dilution, but, you know, it's able to rise. So you can see then what happened once it was able to hold, and then it broke out, you know. So that's an example of definite dilution going on, but it doesn't mean the stock can't rise. If the promoters and the insiders, whoever is doing the dilution, if they sell smart so that the stock is able to rise, then the dilution doesn't have as much of an impact in the beginning, but it will always catch up to the stock. For instance, look at AMWI here. All these shares traded in that huge tank from $1.30. Now it's all the way down to 7 cents. So it's down, you know, 90% from the highs. Why is that possible? Because there was so much dilution, so many shares traded. You know, now people are just left holding the bag. But if you were smart and you played it with a plan and took profits on the way up, like we always recommend people do at stockhaven.com, then you benefited from it, and the dilution was really a non-factor for you. SPAH is another example. Look, no previous trading volume. 676 shares, 130 shares. But then the promotion starts. Definitely dilution going on. 10 million shares trade, way more than any previous time. But it was able to go green, and it rose. So people still play it because they say, okay, there's dilution going on, but it's still rising. It's still a good stock to trade. And then you can see another 2 solid days. Definite dilution going on, but it's okay. We're rising. And this is, again, why you have to take profits on the way up, because you can see, once again, dilution will always catch up to the stock. And as you can see, SPAH has fallen from 80 cents down to about 20 cents. So it's down, you know, massively, 75% just about over the last couple days. So the thing to take away from this video is when you see abnormal volume relative to the previous trading on the stock, that is your first sign of dilution. And if the stock goes red, then it's not a good sign because they're just going to dump it and dump it and dump it. The diluters, the people who are diluting, are telling you if they let the stock go red, they don't care where they sell. Now, if the stock goes green while they're diluting, the diluters, the people who are selling, are telling you they want to sell at higher prices and they're going to let this stock breathe and they're going to let it go on a run. But in the end, they're still going to dump and it's still going to go way down. But that doesn't mean you can't make good money. So, put simply, crazy volume out of nowhere on a stock that doesn't really trade a lot of volume at all, that is your first sign that dilution is going on.